So again, we're focusing on defensive assets, the less glamorous one. And starting in, I guess, reverse order, so the most growthy of the defensive ones is gold. And gold is a very special commodity and plays a really important part in portfolios if you live in a country which has a commodity-based currency. So if you're a South African, Canadian, or Australian investor, this is a really important part of smoothing out your portfolio. It's less important if you're living in the US. It's less important if you live in Europe or in the UK. But in Australia, Canada, and South Africa, we live in a commodity economy. And so when markets get global markets, global equity markets, global economies get the jitters, asset prices move downwards, that investors tend to flock away from commodity currencies to the US dollar. And what that means is that the Australian dollar falls relative to the US dollar, meaning that your overseas assets are now worth more than they were. So even though global asset prices have fallen, because the Australian dollar has fallen too, that helps cushion the blow to your overseas assets. And gold has a special role here because not only is it, so the Australian dollar has fallen, investors have flocked to the US dollar and to gold. And because gold is quoted in US dollars and to a significant extent produced in Australia, that then has the effect of pushing up the US dollar price of gold. And because the Australian dollar has fallen against the US dollar, that gives you a double whammy in Australian dollars. So that's why it produces such a big impact on volatility for an Australian investor. And people like Warren Buffett or the tech bros on Reddit will diss gold and go, well, it doesn't produce any income. Most of it sits around in central bank vaults. And every ounce of gold that's ever been mined is still in existence. So in fact, the stock of gold is about 58 times annual gold production. And so people go, well, therefore it's useless. And certainly if you listen to US-based content or you hang around on Reddit, you will often find this negative sentiment. And in the US context, that's got more than a germ of truth. But if you live in a commodity economy, which we do, then you've got to forget what you hear on TikTok and on Reddit about gold and look at the evidence. And the evidence is, at least since we came off the gold standard in the early 70s, that gold has performed a valuable role in dampening volatility. So the question for an Australian investor then is, well, how do I access it? Traditionally, that meant buying physical bars, gold, which obviously you've got to store somewhere. They generally have a higher margin on them. But today, there are a number of exchange-traded funds or ETFs that you can buy that allows you to buy what amounts to physical gold. And I am distinguishing here between physical gold and gold mining companies. Gold mining companies give you some of the benefits, but not all of them, because they're obviously got real businesses and they tend to move with the equity markets. So look here for physical gold. And there are 4 ETFs that you can buy today. 3 of them give you access to physical, backed by physical gold. And 1 is backed by the right to acquire gold. So PM Gold, PM stands for Perth Mint. I'll come back to why we don't like it, even though it is the cheapest one. But all of these will give you access to physical gold. The beta shares QAU is a fairly new one here, but because it's currency hedged, it removes that big benefit of the currency exposure, which is what you want to give you the volatility damping. So I would exclude QAU from this analysis. And so when we look at the available options, you can see here that the Perth Mint and the ETF is or Global X Gold Bullion, which has the ticker symbol GOLD. They've performed broadly the same. They do have a slight difference. So over a decade, there's about a 9% difference between the two. Much of that can be explained by the fee. But the important point is that PM Gold is a right to acquire gold, exercisable against the Perth Mint, which is backed by the West Australian government. So it's not, whilst it's not as good as physical gold, it really is the credit of the West Australian government. The two things that I don't really like about it is that it's in effect a derivative. That is, it's a right to acquire it rather than a physical asset. And Perth Mint has had a very patchy compliance track record over the recent years. And these sort of housekeeping things probably don't matter too much when everyone's making money. But when things get a bit rocky, they're the red flags that you've got to be careful about. So from that, we look at gold from the ticker gold for that reason. You can see down the bottom of this graph is the currency hedged one, which obviously hasn't benefited from the fall in the Australian dollar over that period. And there's also some costs involved in the hedging. So when we come to choosing a gold investment, our preferred investment is Global X Gold Bullion. It's got ticker GOLD. It's the biggest of all of these ETFs at 2.7 billion. It's the oldest. It's backed by physical gold. The disadvantage is got a slightly higher fee. So PM Gold, as I said, is slightly outperformed at a lower cost, but it's not backed by physical gold. QAU is hedged, so we rule that out. And NUG is probably the new kid on the block. We're tracking it. We're looking at the opportunity here. It does have some sustainability credits. So if you're looking at an ESG portfolio, NUG might have some merits. But gold generally lowers the overall carbon footprint of your portfolio. And it's largely for the reason I mentioned earlier that most of what you're buying is existing gold, which is 58 times the annual production. And so even though the mining of gold might have some environmental consequences, most of what you're buying is existing gold, which is either been recycled or moved around in a warehouse. So for all those reasons, we like gold, and you'll find gold in most of our life Sherpa portfolios.